You have to work, live, and at the same time invest so that the 40 years that you'll not be working, you'll not have the energy, then you'll be able to still survive. So wealth is measured in form of time. The best way to start a business is first to be an apprentice. You might think you're investing, but from the fund manager's perspective, they are doing business with your money. The life that we live is filled with so many distractions that we are unable to live that perfect or ideal life.
Wealth is not measured by what you have, but by what you can give and what you can sustain. This is the Epic Show, where stories of faith, resilience, and transformation meet purpose. This is where we talk about transformational things, stories and lessons and topics that will make you a better person. Because you have to understand, you're not competing with your neighbor, you're competing against yourself. You have to become a better version today than you were yesterday. We're going to be talking about an interesting topic, but before then, special thanks to Jarika Hotel, located in Nakuru County, for giving us an ample space where we can be able to broadcast this show and bring it at the comfort of your home. Without further ado, today I want us to dive right in, because I remember we did another episode with our financial consultant, Mr. Joseph, from Ufalme Wetu, that was so intriguing, that had a lot of reactions, and everybody was demanding for part 2. So thank you so much, community, for helping us boost the content. Thank you for liking, subscribing. Thank you for sharing. Thank you so much for helping us grow this community. If you have not subscribed, this is the time to do that, so that you can be informed when we drop new content, which we do it on a weekly basis. Without further ado, I've come to appreciate, love, and honor this brother, Joseph Kanani, a financial consultant from Ufalme Wetu. He brings us wealth of wisdom on financial matters. We believe everyone is a genius in their line of calling. This is his line of calling. And I tell you the truth, tonight's episode is not gonna be different, because we are talking about wealth. We are talking about investment. How do we invest? Who are the robbers of wealth? All these topics and much more will be answered by none other by our financial consultant. Kindly help me welcome him, Joseph Kanani. Asante sana for being here.
Asante for having me.
Thank you so much.
Asante.
So have you been?
Good,
Yeah.
happy to be back, and glad that people actually listened and took action. So it's a good pointer.
You're still impacting the generation with the wealth of knowledge.
Exactly, with the wealth of knowledge and also with the wealth of the heart. Yeah.
Which is very key.
Which is very key.
We're going to be talking about an interesting topic. What is wealth?
Yes.
If I may pose that question to you.
Yeah.
Right in the middle of this hot discussion, what is wealth?
Okay. To answer that, let me use a very common quote that people have. We say that time is
money.
Yeah, but I think that is wrong. Time should be wealth. The only part where time is money is if you paid per hour. Or if you're paid for the work that you've done, maybe at the end of the month and all that. So unless you put in those hours, then you won't have that pay. But in real sense, time should actually be wealth in two ways. One, let's assume someone is 40 years old today.
Okay.
And they pray hard, they eat well, they exercise, and they intend to be 100 years old. So what does it mean? It means they have 20 years to work and 40 years to just live, right? Where they are not working, but they need to live. Yeah. So it means these 20 years, you have to work, live, and at the same time invest, so that the 40 years that you'll not be working, you'll not have the energy, then you'll be able to still survive.
Wow, that's profound.
In the second way, look at it this way. Let's assume 70 years old and the life expectancy is about 80 years old.
You have 10 years to die.
Let's say you have 10 years to die. Just giving an example. And because of your financial status and the family, you're able to see your children and your grandchildren only once per year during Christmas. Because one, you can't afford to go to them. Two, they can only afford to come to you once. Yeah. But what if you had the money and the ability such that in 1 year you can be able to go there over Easter, once in August and again in December? So what does it mean? While you didn't have money, you only had the chance to see your children and your grandkids 10 times because every once in a year, and you live maybe for another 10 years, so only 10 times. But because you have wealth, you've been able to create 3 more meetings.
Wow.
Such that now you have 30 interactions left instead of 10. Not everyone can be able to do that. Why?
So wealth can be measured by time.
Wealth is actually measured by time. And it doesn't matter how much money you have, because as we shall see, there are things that rob that wealth.
Robbers of wealth.
They rob that wealth. And it doesn't have to be a real thief, or it's just things that we do and practice that rob us that wealth, such that from statistics, I like using statistics a lot. Do you know the people between the ages of 0 to around 59 are 96%, and only 4% are above the age of 60.
No kidding.
Statistics don't lie, numbers don't lie.
Wow, really?
What does that mean? People are born, they go to school, they go to work, they retire and die.
Hey, Simon Makonde.
Yeah. Why? Because they don't have the wealth to survive after 60.
This is a painful truth.
It's a painful truth. Statistics, check them out. 4% above 60 years old. Statistics show that retirees either die or go back to work because they can't survive. And why can't they survive? Because they do not have wealth. They had money, but they didn't have wealth. Because now wealth has, and it might, I thought about it, and people usually say, but I see old people everywhere. But just go back to a setting like your church. How many 80-year-olds are in that church?
For real, you want the honest truth?
Yeah.
None. I haven't seen an 80-year-old, for real. In my church,
Yeah.
I haven't seen an 80-year-old.
But recently I was listening to S.K. Macharia speaking during a burial of his friend. They are both over 80. But you see, because he has the money and the wealth, he still looks like he can go another 10 or more. Why? Because the people who are, the way the economy is such that you cannot be able to live even off your children because they also have obligations and they're trying to survive.
Yeah.
So at some point, bills, medical bills, hunger itself, stress will definitely kill someone. So wealth is measured in form of time.
Wealth is measured in form of time. What
Yes.
are you doing with your time?
Are you investing enough?
Are you wasting?
Yes.
Are you spending?
Yes.
Because I find time is like a currency. You can
It
either
is.
invest it
It is or waste it.
or you can waste it.
And it comes around when you're now retired, when you don't have the energy to go to work.
I heard a certain Mzungu say, Eric, you either pay now and play later,
Yes.
or play now and pay later.
Definitely true.
So whatever you're doing right now,
It will determine what later will be like.
yeah. So the pay you can choose to pay the price to create wealth and invest right now, or you can play now and pay heftily when you're in your 50s, your 60s. And that's why we have very many bitter people who are 70, 60 years old.
Yes.
Because they miss this gap.
They miss this gap, they do not, and they know that there's nothing they can do about it, because once the energy is gone, you don't have the capability to work, you don't have the capability to create wealth.
There is an analogy you gave last time you were in the studio when you told me, I gave an example of a TV.
Yes.
You remember that analogy?
Yes.
I give an example of a TV. I think it was 85-inch. It was just an imagination. We are talking about production versus consumption.
Yes.
No, there was a particular point you said. We think production, not consumption, for lack of a better word. Now, that TV, I said I can buy that TV 100,000,
Yes.
and then you said I'll be robbing time from my life. It's like I'm robbing my future. What did you mean by that?
Okay, look at it this way. We'll get into the depth of this, but look at it this way. Assuming there is an investment platform where you can invest a certain amount of money and get an interest out of it. Yeah?
Yes.
So if you can probably afford 10,000 shillings per month and you invest it for the next, let's say, 25 years. So it will have created a lump sum amount or a certain amount of money that after maybe the 20 or 25 years after you retire, you can be able to live off that.
I get that.
Yeah? Assuming that your lifestyle now requires you to live on about 20,000 shillings per month. It's just an assumption. 20,000 shillings every month. So it means if you want to live for another 40 years, you have to have invested money or in things that will give you the equivalent of your lifestyle every month for the rest of your life. So if today people usually use the word invest loosely, but if I bought that TV for 100,000 shillings, it means rather than invest it means that there are 5 months I have consumed now.
From my time.
Yes.
That's true. That is very true.
Because those are about 20,000. So if you had invested them, maybe they would have probably created another 2 or 3 months because of interest.
Yeah.
So some people, it's not the TV for 100,000. It's cars, luxury things, trips.
What you're saying is so profound. You know, there was a time I was listening to TD Jakes, and he said the same thing you're saying.
Yeah.
But he gave this analogy. He said, for example, if you're getting a salary of 30,000 shillings,
Yeah.
all right, on average, you're getting paid 1,000 per day. Sindio? On average.
Yes.
So if you go to the shop and buy a shoe worth 5,000,
Yes.
you have consumed 5 days
Yeah.
by your shoe.
Yeah.
Are you getting the point? So he was saying that to help us understand you are not just spending money, you're spending your life.
Exactly. So it's if people understand that the time you have to work is the time now you have to invest so that it can pay you when you're not working. And the reason now, maybe coming back to the statistics, the 4% and all that, normally, like when someone starts working, you expected to like have an ideal kind of lifestyle where you go to work, you come back home, you save, you go to work, you know. But in real sense, you have obligations. In real sense, you have what we call the black tax. Like at home, simply means that people at home are expecting you to support them.
Oh, that's black tax.
That's black tax.
Hey, that is very black.
Which I don't think it's that bad because
but
we're
it's
also
very
products of that. Because especially if you're a firstborn, it means other siblings will have to depend on you. If your parents are not doing well, it means you'll have to,
You have to support.
All that money is money that you could have been putting towards your future, but you're spending it elsewhere. So at the end of the day, you find that you have little or nothing left to save for your future.
Oh, that's the truth. That's the truth. That's the reality for most people.
Yeah, but since you have that, constant income that is coming in and out, you think you're okay. You're able to meet your daily needs. You're able to meet your emergencies. You're able to, drive, move around, rent, pay school fees. But once the energy and the time to work are gone, that's now the realization will hit that I should not have done this with this money. I should have done this.
Now, allow me to take you to a question that we tackle in another episode.
Yeah.
all right? Because I want you to help us understand, how do I invest?
Okay.
All right?
Yeah.
But before we talk about how do I invest, assume that I have a salary of 30,000. My bills are hefty. I need to start saving a little bit, so that I can get something to invest. Practical, how do I save? And then we go to how do I invest and where do I invest?
Okay, that's a good question. And I remember even at that time we talked about first saving before investing.
I remember you say that, yes.
And then
yes,
investing.
yes.
And I think one of the, if you study the billionaires and the millionaires around, you find that the reason why they are where they are today is not because of these normal investments that we talk about, the money market funds, the shares, etc. It's because of businesses that they build over a long period of time.
Okay.
Because the good thing about business, that's where now it gives the differentiation between time is money, because you're working towards a salary at the end of the month, and business, which has the capability to be exponentially scaled. Like you can scale it to millions, from millions to billions.
That's right.
Unlike a salary, you can only scale it to very small levels very often. So as a young person, as a person who is starting with employment, with earning, your motive should be to save towards starting a business.
Save, that should be the motive.
Yes.
Save towards starting a business.
Yes.
So what you're telling me is that I first identify what I want to do,
Yes.
and then I save towards that.
Towards that.
What
Learn
if I
from
start the other way?
mistakes. Like, how which other way?
Because I just save as I'm thinking, what can I do with this money?
The problem, okay, it's a good question, but it has two ends. Yeah, there are people who do not have an alternative, so they start the business anyway and work towards, starting from small, growing through the levels until they make it. Yeah. We have those stories of rags to riches. But now I'm saying someone who is employed, at least they have a better platform
that's true.
than someone who is starting from scratch.
Very true.
But not the two outcomes that usually happen that way is there are people, especially even retirees, when they retire, they see that my neighbor has a hardware and it is doing very well. Let me start a hardware. They have the capital, but they do not have the experience, they do not have the know-how, they do not have the demonstration skills, they have nothing. Oh. So they invest all their money in that business, hoping it will pick and do as well as the neighbors. But
and then
flops.
it doesn't.
Yes.
Uh-huh.
But there's the other outcome. People start businesses and they do well. So it's either way.
Okay.
But I think even from those previous episodes, I think I once stated that the best way to start a business is first to be an apprentice in
and
that
learn.
business.
And learn.
Yes.
All right. That's fantastic. So saving comes before investment.
Yes.
That's very clear.
Yes, and I'm saying that the best investment that you can ever do, because we shall talk about the money market funds and all that, is investment in business, because only business has the capacity to give you exponential growth. You can scale it to whatever limits.
You
that
can
are there.
10x, you can 5x
Exactly.
in a business setup.
Exactly.
All right.
Because even the investments platforms that you're going to talk about, they give you an interest after they have put your money into some other ventures. So they are there to do business with your money, not necessarily to make you rich or wealthy.
They're there to do business with the money you're giving
with your
them.
money, exactly.
You're going to explain that structure.
Yeah.
So how do we invest? Because before we go to where,
Yeah.
how do we invest?
So this is my advice to every young person, anyone who has started employment or is looking to go towards employment. So the first how is invest in a business. There are two ways you can invest in a business. Either you start one or you join someone who is already doing it. Okay. Yeah, and that way might mean having a partnership agreement, something like that. Yeah, or being a venture capitalist. Like you can have a lot of money, but you're in the office all the time, but you see potential in someone, so you give him the seed capital to start, and when that business drives, you can be able to to go far. In the US, they have this thing they call venture capitalists, and venture capitalists usually make a lot of money through what they call the exit route.
Okay.
That is, they see a small firm that is starting, maybe in the digital field. This firm starts small, like the way Uber started.
Yes.
The people who invested the first seed capital, when Uber was now being, what is it called, being put in the public offer,
yes.
yeah, for the public to buy shares, their investments had 10x, 20x, 100x.
Yes.
So by the time they are selling, they have made their money.
Okay.
Or people like Elon Musk, when they made the PayPal thing. So when they sold it to the next company, so even whatever they had invested little, they were able to like 100 or 200 times exit. So, but in Kenya, that culture is not that popular. Where
But I think
you
it's
sell
because of
businesses.
trust.
Yeah,
Is it because of trust?
I think
Or
so.
we don't have ideas? Because you see, when you're talking about venture capitalists, you can say, for example, someone is earning 500,000, right? They really don't have time
Yes.
to venture into business.
Yes.
But then here I come, I find Joseph, who is so passionate
About this idea.
about he's a good mechanic and all that. So I think, Joseph, see, I have this land. See, we can do big things. So I bring you the material, the equipments. I bring you everything that you need, the scanners and all that. But you,
It's a problem of trust. I can't be trusted with your money.
yeah,
Yeah, it's true.
could be the reason it's not working in Kenya.
Yeah, could be the reason. And the second reason is that ownership mentality. Everyone wants to be the owner of something. Like, if someone came and told me, I'll buy 80% of your company, and I feel like I'll be left with 20%, I feel like I'll be inferior, so I don't want that. So that is also another thing. People want to, and you know, for you to access that capital, you have to give up something. And what you have to give up is that shareholding. Yeah. So I think that is the problem. That ownership mentality, people want to own and be associated with something as theirs, but they don't want to invite investors because investors will take most of the shareholding.
All right.
Yeah.
So the greatest investment somebody can do is invest in a business.
It's invest in a business. That will always be the bottom line. Don't think is this one billionaire you can name and not name a business that he has founded.
No billionaire with employment.
no billionaire with employment, or no billionaire with the money market funds or something like that. Yeah.
They are associated to a
Businesses.
particular business.
Yes.
All right.
Yeah.
That's very important. Now, where do we invest?
Now, I would first of all say we start by saving, and there are saving mechanisms, and one of the most popular ones that is there is the money market funds. You've heard people talking about the MMFs,
I have.
the money market funds.
It's trendy.
It's trendy, but it was trending very much last year because the interest rate had gone up to around 18%,
Now they are.
at around 9-10%.
They've dropped that much.
Yes. But it's simply this reason. Money market funds are for people who want to invest in government securities. There are two government securities. One is called treasury bonds and the other one is treasury bills. The difference is that treasury bills are a short term, like
6 months.
they think 30 days, 60 days, 91 days, something like that. But the treasury bonds are long term, sometimes up to 25 years or even more.
So what we're talking about is that you're giving your money to the government
You're giving your money to the government.
so that the government can use this money
Yes.
and then there is a return.
Yes, there's a return.
Yeah.
So sometimes, if the government wants to create that, demand for its products, it raises the interest rates. When it has excess cash or it has a lot of debt, it lowers the interest rates, like right now.
So anytime you see the interest rate, for example, your treasury bonds increase,
Yeah.
it's because they need.
They need money, and they need you to take your money from other investments that are not earning as high and take it there.
So that they can invest in whatever they want to invest.
To do actually it's for the budgeting process. Yeah. But now the problem is, as individuals, you and me, you cannot just go to central bank and say, I want to buy this amount of treasury bills or these treasury bonds. That's why we have to go through, because one, the threshold, like you see, maybe they say every unit costs about 50,000 shillings.
Yes.
But you might only have about 20,000 shillings. Or as you're doing the example with 30,000 shillings, you might only have 2,000 shillings to invest at the end of the month. So that is where there are these, what we call the fund management firms. So the fund management firms are licensed by the Capital Markets Authority to collect money from the public, pull it together, and then use that money to invest, or rather to buy the treasury bills and the treasury bonds.
Oh, so that's perfect. So I can come with my 2,000, you can
Yes,
come with your 10,000,
exactly.
and then go to the funds management,
Exactly.
whatever,
Yeah.
and then they can invest.
That's what they're called mutual funds. Mutual meaning it's from me, from you, from him. So you bring your 1,000, someone else brings his 10,000, another person brings. So when now they have this lump sum, though they go and buy the treasury bills, they buy the treasury bonds, and they can be able to do it every other week, every other month, every other year. Unlike you, who might only have some money at some points in time. And I remember I said something very, it might look controversial, but it's true. You might think you're investing, but from the fund manager's perspective, they are doing business with your money. Look at it this way. Assume that you say you've invested 10,000 shillings, yeah? As you've said, the money market funds right now, their average return rate is about 10%. Let's say 10%. So 10,000 will earn you how much?
10%.
10%. So 10,000 will earn you 1,000 shillings.
10,000 is 1,000.
Yeah, at the end of the year, right? Yeah. But for these money market fund managers, the ones who collected your money, they'll get a 2% fee out of it. So meaning you're getting 800 as your return. The fund manager is getting 200 as their return. But remember, they have collected this money not just from you.
From many people.
From millions of people.
And they have invested this money.
Yes. So for them, 1 million people, each giving them just 200 shillings, it's 200 million. So for them, it's business.
Wow.
So we have to. I'm saying this because sometimes we react emotionally to advertisements. So you think you are investing.
They really want you to
really,
be.
They want you to give up your money so that they can make money with it.
Wow.
Yeah.
But because it is bringing us some produce,
yes.
some benefits.
Yeah, it's a way of investing. A way of saving. Let me use the word saving.
It's a way of saving.
Saving. Because the reason why I'm saying it's a way of saving is because if you keep that money under the pillow, inflation will beat that interest rate. That if the inflation rate is 6% and they're giving you 8%, you'd rather have that money saved there so that your money does not lose value.
Because it might lose value if you don't do that.
If you don't do that.
Because of inflation rates.
Exactly.
Wow.
And the reason why people, not the people who really understand how those financial markets work, it's people who already have businesses and they have idle cash. Like if I have an enterprise and I have maybe between making another order, I have about 10 million shillings. Instead of it laying in the bank, I'd rather put it in a 30 days investment, money market fund. Yes. And when I get it back after 30 days, it will have some
there's like a small percentage.
Yes.
Yeah.
Because if it just stays in the bank, all you'll get is the monthly ledger fees and the transaction fees. Yeah. So the people who understand that, it's usually called a cash equivalent because you're able to convert it into cash quickly.
Okay.
But to us who are the majority of the population, we should look at it as a saving platform.
It's a saving platform.
Yes. Although when the fund managers will market you, they'll call it an investing platform.
But it is not.
But it's not.
In reality, it is a saving.
It's saving.
All right. That's the money market fund. What are special funds?
Now, the reason why I brought up that part of special funds and the money market funds, it's one, to explain, and two, also to demonstrate why this gap between the poor and the rich will never end. Because look at it this way. if you're earning 100,000 shillings, for instance, you're in the middle class, right?
Yeah.
Tell me, how much, with all the distractions in life, you have the black tax, you have your rent, you have your family to take care of, you have your other utilities to take care of. How much do you think you'd save in a month?
With 100,000?
Yeah.
Very less.
How much? Like, just give me a figure.
Maybe 5 max.
5,000 shillings, right? So, meaning if you're putting 5,000 shillings every month in a money market fund, that's about 60,000 at the end of the year. 60,000 at the end of the year, at 10% return, it's about 6,000 shillings.
Minus their 2%.
Minus the 2%,
You're talking
you get about 4,800 in your return. Yeah? But we said, if you look at it as a saving platform, that's a good thing.
Yeah.
But if you look
because
at
it will give you a cash equivalent.
Yeah, because the reason why I don't want to use the word investing is because when we invest, we create wealth.
Oh.
But when we save, we just...
it's a cash equivalent. We are not really losing.
We're just one step away from inflation. It's like inflation is chasing us.
We are beating inflation.
Exactly.
Okay. So is that what you mean by special funds?
No, that's what I mean by special funds. I mean, now I have given you that example, right? Tell me, if you are a high net worth individual, you're earning 2 million shillings every month.
Okay.
How much would you save?
Oh, almost 500,000.
500,000. Tell me, if I have 500,000 shillings, do you think I'll take it where it's going to earn me 10%, or I look for a special fund where it will earn me even more?
You will look for a special fund when it will give you more.
Exactly.
Now you have bargaining power.
Yes. So basically, the fund management firms, they have been able to also classify the market. They know, as we had said earlier, that majority of the people are poor, and there is a very small class of high net worth individuals. These high net worth individuals, they have businesses, they have ventures that they'll do, and they'll get a return of 10% or even more.
Yes.
But if we give them 30% return on their money, then they'll allow us to use their money to make money.
Yes.
So this poor person has been told you can put 100 shillings, you can put 10,000 shillings, you can put whatever you want, but you can't go to the special fund unless you have 500,000 shillings to start with.
You cannot. So mutual funds ndio zinaenda kwa special.
No.
Because they are collecting money.
No. The Capital Markets Authority only allows them to invest in the money market funds, the treasury bonds, and because they are secure. The government never fails to pay, so they say.
So it's secure?
It's secure. You know, you cannot use your money. Well, that's what they say, but at least in Kenya, it has never happened where the government defaults. Okay. But now, as you've said, if I'm a high net worth individual, I have 500,000 that I'm able to save every month. Then when I go to a funds manager, they'll not put me in the same class with huyu mtu wa 10K. No. Watanipatia products. Waniambie, we have this. We can invest in a sovereign board like Eurobond. We can invest in gold. We can invest in oil.
Directly, as an individual?
Yes.
Wow.
We can invest in oil. We can invest in the London Stock Exchange. We can invest in the New York Stock Exchange.
You're kidding.
It's true. It's there. But why don't you know that information? Because most of us are in the 80%, and we can only afford the 100, the 1,000, the 5,000, at most 10,000. But this class are able to, because of the threshold. Because if they tell you you can only enter with 500,000 and the monthly top-up is 100,000.
You must be a high net worth individual.
You must be a high net worth individual. And then they give you a return of 30%.
What?
The gap between the poor and the rich keeps on widening. Because this person saving 10,000, they're getting the 8%. But this person saving 500,000.
It's getting 30%.
It's getting 30%.
Kabla tukasirike, talk about stock exchange.
The stock exchange is now where the listed companies some people call them the blue chip companies. Others call them the 20 index stock companies, where companies that have issued their shares to the public. Because the classification of businesses, there is a sole proprietorship, the partnership, the private company, and then the public company. The private company is owned privately by people. The public company is owned by the public. Like Safaricom, the shares have been issued to the public through an initial public offer, the IPO. So means the public or majority of the people can have access to those, they're the shareholders.
Yes.
Now what happens is once the IPO is done, the company closes its books. It says, now we have raised this amount of money. These are the shareholders. But as a shareholder, let's say me, I want my money back. I can't go to Safaricom and tell them, I bought a share at 100, please give me back my money, take back your share.
Yeah.
No, you have to go to the secondary market. The secondary market now means there has to be a person who is willing to buy the share,
Yes.
and someone willing to sell the share. Now that's the stock exchange. So you exchange through the Nairobi Stock Exchange.
So those are now like the mediators.
Exactly.
Yes.
And shares are very funny because their prices are responsive to the information that the public has about the company.
Or the product.
Yeah, all the product that the company is making. Because if, for instance, when Safaricom announced it's expanding to Ethiopia, and people thought, oh, so the profit is going to be more. So that perception made the shares of Safaricom to go up in price, because it's basically the law of demand and supply. There was high demand for the shares, so the prices went up.
That's right.
When the perception is that the company is going to make losses, what happens is now everyone want to sell, and few people, yeah, so the price again goes down. Now the problem is a lot of people, especially what I would call amateurs in investing, they work on that information. They work on the information that is in the public domain. That is, they sell when everyone is selling, they buy when everyone is buying. And they end up frustrated because their mission was maybe to make money. The difference in the share prices when they were buying and when they are selling, but it goes against them. But the secret to making wealth through the stock exchange is longevity. That is, you buy shares, you accumulate them, and then you forget about them for 10, 15 years.
Oh, lakini sasa unaona walala hoi hatuna hiyo time.
Now that's the problem.
Walala hoi unaweka 100,000 unashinda kuchungulia what am I getting from this?
You don't have
You don't have hair, no hohe. You see, this needs somebody who has money, idle money, and they can be able to say, for this 100,000 I'm not going to be using for the next number of months, years. So let it.
And that now gives us a very good roadmap towards what we are going towards when we said that time is wealth. Because this person who could be able to afford that 500,000 to put aside the 100,000 every month, at the end of his working life, he has accumulated all that amount now.
Very true.
And now he's able to live on the same kind of income as he was when he was working. But this Jorge, who could only be able to save 5,000, but even after he retires, life will not be worth, his living standard will not go back to 5,000. No. He'll still have to pay medical bills, still have to use transport. So it's still way above. So the 5,000 now, and he can't be able to live on it for a long time.
Wow.
Yeah.
This is relevant information. Now talk briefly about what about banks and SACCOs? Where do you categorize them?
No,
because your segment yote tunaongea kuhusu savings. It's all
savings, exactly.
Yeah, because you're not really calling them investment according to your definition.
Yes.
You're calling them savings.
No, but when it comes to shares now, that's now when the investing starts kicking in.
Shares.
Because it is long term, and it's a little bit, I can say, by a sophisticated investor. Someone who knows when to buy, when to sell, which share to buy, which one to sell, which one to hold for a long time. Exactly. Those are sophisticated
all those dynamics.
Yes. And that is where now the fund managers are there. because these sophisticated investors can afford their services.
Now, Abu, before you go to banks and circles,
Yeah.
what do you say about the forex exchange?
Now, forex exchange in in the, let's say, the social, it's called the pop culture. It's very kind of hyped very much.
Sababu
by people.
nakwambia TikTok unatusumbua vijana. They're telling you they're making thousands in hours. Unashangaa, why on earth am I working this many hours?
But let me give you a scenario, and then you make a decision for yourself. Yeah, forex exchange simply means, or rather, forex gain simply means that when you're holding a certain currency at a given price, then you sell it when the value of that currency goes high. That margin is what you make as your money. Let me give you an example. Currently, the dollar is trading at maybe 130. Mm-hmm. Let's assume that is it, right? Mm-hmm. You have $1, right? If tomorrow the same dollar will be trading at 135 and you go and sell it,
you have $5.
No, 5 shillings.
5 shillings
yes.
per dollar. Yeah.
So 5 shillings per dollar. Mm. So it means to make 5,000 shillings, you need $1,000.
That's 130,000 shillings.
Yes, just to make 5,000 shillings.
Yes.
So to make 5 million shillings, you need $1 million. Tell me which kid has $5 million lying somewhere, waiting for the values to fluctuate so that he can sell and buy.
And why not go to the special funds if you have that money?
Exactly. So you make your decision whether it's foreign exchange or it's foreign exchange.
Let's call it foreign exchange.
Forex exchange.
Let it remain foreign.
Yes.
All right. Now about SACCOs and tafadhali. You remember watu wamenyoroshwa juzi?
Yeah, SACCOs were a very good mechanism for saving to borrow. Yeah.
So that's the purpose of a SACCO.
That was savings and
saving
credit.
so that you can. It's a savings and credit.
Yes, that's what they're called.
Oh, savings and credit corporations.
Exactly. So you're saving so that you can get maybe credits.
So if you're putting your money in a SACCO, now uchukui loan, you're wasting.
No, you're not really wasting because they give you a small, they call it rebate, a small, like a dividend on your savings, because the people who are borrowing, so they are paying with interest. Yeah. But the credit is also good, because one way to create wealth is maybe using credit wisely. Because if you can be able to access credit at a cheap rate, because SACCOs were for that. When banks are giving out loans at
18%.
Banks they are at 18, 20 something percent. SACCOs are giving at 12% because it's about 1% every month.
Yeah.
So if someone is able to create wealth using credit, then that was a very good avenue.
That is true.
Yeah. But now the problem is, as you said, trust. Because when this money is trusted to a few people in the who own the SACCOs, and it comes time to do campaigns, they use your money, and the SACCO collapses. It happened with,
Yeah. Don't mention.
So SACCOs are very good, and SACCOs, they've been made for various people, like the walimu have their SACCO, the police have their SACCO, watu wa stima, accountants have muhasibu, I don't know, teachers, yes, they have for them. So it's good for even your profession, you can be able to analyze the SACCO that your profession is under and tell whether it's strong or not, and then you can be able to save, but with the intention of borrowing. And
even
borrowing,
a business person,
exactly.
You go to a SACCO, save with the intention of borrowing.
Yes.
Talk about the bank.
Now the banks are, I think the best business model ever made was the bank, because it's the only institution that uses other people's money to make their money.
They use OPM.
And they do not have to pay you for that. At least these money market funds, when
they're paying you for using your money.
Yes, they pay you 8%, they take the 2%. Banks, if you deposit your money, they have what they call the 10% rule. They are required by central bank to have a certain limit that is not lent out, which is about 10%. But they also have what they call the multiplier effect. Like your money can be lent out up to 10 times. Because, okay, look at it this way. Let's say you deposited 100,000 shillings. Someone comes and you don't use it for a while. Someone comes and borrows the 100,000. Then that money, when he's not given at 100,000. It's put in his account.
Of course.
And then he doesn't use it all at once. So another person who comes and borrows 80,000 shillings, an amount will be credited in his account.
Can be given from this amount.
Yes. Another person 70, another person 50, another person 20. So the bank can lend out money for as long as they can create accounts.
What you mean is that the bank can give 1 million shillings
Yes.
to 10 individuals.
Yes.
The same 1 million shillings.
Okay, it not look as if it's the same.
Na nyinyi wote mnakuja mnasema I need $1 million and they deposit $1 million in your
Yes,
account.
yes.
I need $1 million in your account. But because we are not all going to use the money all at once.
That, and also the reason that right now a lot of our transactions happen electronically.
Yes.
Like, I'll rarely have that 1 million put in a bag, in a duffel bag or somewhere in a briefcase. It's always send this to this, send this to this. So as long as the bank is able to debit your account and credit someone else's account, then it can lend that money as much as possible. And that's why even when the economy is doing very bad,
The banks are still
tell me who is making billions in profits?
the banks.
The banks. Even small banks are making a lot of money.
Now let me ask you, why would I save my money in the bank when I have all these other options?
Okay, one, I think there's a tradition like people have, even when you're in school, you're told open a bank account, When you get employed, the first thing they tell you, give us your bank account. Money will be going through there. So there's also that I think in the early 2000s, there's like an eruption of people wanting to support local banks, Family Bank, Equity Bank. And so a lot of unbanked people started having accounts. Wamama wangeweka, mtu ametoka kuuza nyanya, they have 123 shillings, they can deposit the full amount as 123. So I think the mentality that has been created around banks, which I give them props for marketing. It's very good. And people know that their money is safe, but what they don't know is that their money is being used and they're not being given anything in return.
Now let me use this analogy. You tell me, as a financial consultant, because now I have an advantage of getting free financial consultancy.
Yeah.
By being the host.
Yeah.
Now let me ask, I have 100,000 shillings.
Yes.
All right? Instead of me saving this money to the bank, okay?
Yeah.
I save it in an MMF.
Yes.
Okay? If I'm intending to get credit, I start saving in a circle and use my bank account to receive salary.
Yeah.
How wise is that?
Okay. The good thing about, or rather the whole financial system is interconnected, because every financial fund manager has to have a caretaker bank. So somehow the money, as much as it's working, it has to go through a bank. Yes. Yeah. But what you're saying is wise. One, you're saving in a money market fund, but remember, it's to beat inflation.
Yeah. I'm not calling it an investment.
You're not calling it an
investment. From the knowledge you've given me,
Yes.
I'm not calling it an investment.
You're beating inflation.
Yes.
You're 2 steps ahead of inflation.
Okay.
2, if you're looking towards getting credit, so you're saving another amount in a circle.
Yes.
So this amount you're saving in an MMF, it's also like readily available when you need it. So it could also be emergency fund, etc. Whatever you're saving in the circle, you're looking towards building something.
There's a goal.
There's a goal.
With my money in the circle, you see, they tell us like 3 times, 4 times, 5 times.
And that goal now is what now should be the investment.
Yes.
Because if you're about to get 1 million shillings, then they should go towards a business. But you can't get 1 million shillings loan from the bank, or rather the circle, and then put it in an MMF.
No, it doesn't make sense.
It doesn't make sense. But you can take the 1 million and put it in a special fund, because you'll be paying interest here 18%,
And still you have 12%.
and they give you 30%. Yeah. So in that case, in your case, I think that would be wise. You're saving your salary in the bank, you're saving in the circle, you're saving also in the money market funds.
Tuongeleshe Mama Mboga ambaye alituchanganya sana na kutuleta serikali.
Bottom up.
Power bottom up.
To the people.
Power of chamas. Or what do you call them? They call financial money. There's a name. Microfinances?
No, microfinances are actually now non-deposit taking but credit giving. You see a circle, it gives you credit and it also takes your savings. But microfinances are there just to give you credit, you give their logbook and
no deposit.
Pay them,
No deposit.
Yeah. So it's someone's capital.
Just bring a guarantee.
It's someone's business. But my business is, it starts from the Shylock.
Yeah.
It starts from the Shylock. Where I use my capital to give you money, then you return that money with interest.
Okay. You don't need to deposit with me.
Yes.
So microfinances, you don't need to deposit.
You don't need to deposit.
You just need to have an asset, a collateral.
Yes. Then you take a loan. Yeah, but now the problem is, because now these are, they use what we call very predatory rates that unlike banks and SACCOs. But you see now the problem is most people do not have good relations with the banks, because banks have to use things like the Credit Reference Bureau to see your credit worthiness.
But majority of us don't have that.
But this microfinance, as long as you have a title deed or a logbook, chukua loan. Then they use this within 48 hours, what. But you don't look at the processing fees, the insurance for that loan, and the interest rate.
So for lack of a better word, microfinances are just better Shylocks.
They're better, well-organized Shylocks.
Yeah. They are Shylocks with big offices.
Yes, but for the person who is doing that business, it's good business.
It's good business for them.
Yeah, it's good business.
But it's not really good for the consumers.
For the consumers.
Especially depending on what you're using the money for.
Exactly. Because it's predatory in the sense that, we say, a business should be able to give you an investment better than what the most risk-less investment can give you. Yeah. And in our case, the most risk-less investment is in the money market funds, because we're investing in the government. So if it's giving me 12%, then most businesses will give you a return at most, even if you do the Safaricom net profit margins, the equity, at most 20%. At most. So it means if I take credit to do that business, then what I'm getting from the business should be more than what I'm paying in interest.
That is true.
So if I'm getting 20% from the business, and you have taken a loan of 5% every month, so it means I'm paying an interest of 60%. Yes. So it doesn't work in any market, whether Kenya or so that's why I would no offense against any microfinance, but I would advise people, especially when you're building your journey towards business, do not take credit from the microfinance.
Talk about chamas.
Now, chamas are, especially now for the Mama Mboga that you've talked about and all that those people, it's the best entry level to financial inclusion. Wow. Because chamas, you're not judged by how much you have. It's actually the other way around, how much you don't have. So that they can help you to get somewhere. Like, when you go to the bank, you want to look all suited up, you want to be seen holding a lot of cash. But in a chama, it's how much don't you have? How needy are you? How hopeless are you? How hohehahe are you?
Or no hohe, no.
No hahe. So that now you can elevate you to move from that level of hohehahe to a better, maybe
at least,
a decent living standard. Now, there are different kind of chamas, like the merry-go-rounds. I'm sure every person's mother was or is a member of a merry-go-round. Yeah, but for lack of knowledge, you see, a merry-go-round is beneficial to whoever gets the money first, but a loss to whoever gets the money last.
Why a loss?
Look at it this way. Let's say we are 12 of us, and we're getting 1,000 shillings we're contributing 1,000 shillings every month.
That's 12,000.
So 12,000. So the first person who gets the 12,000 will get it in January. The last person will get it in December. But this person who is getting it in December, he started contributing his first 1,000 in January.
And the one who got it in January is already investing.
Exactly. But look, let's use a deeper example. What if the price, this person drives a motorbike, and the price of fuel in January was 100 shillings per liter. So it means with his 1,000, he could afford how many liters?
The price per liter is how much?
100.
10 liters.
10 liters. By the time he's getting his money back in December, the price per liter is 200 shillings.
So she can only get 5.
So your 1,000 has lost value.
Due to inflation.
Because of inflation. But that's how merry-go-rounds work. But people don't have knowledge. But it's a good way for saving, so we can't talk against it. But now we have more organized chamas.
Okay.
More organized chamas. Actually, our work at Ufalme Wetu is to create what we call peer banks. We want to create a bank in every village. But this bank is owned and operated by the people.
Okay.
The people who would normally form a chama, they would normally also take their money to a bank, right? But the bank gives credit using their money, but doesn't pay them. What if now they form this chama in form of a bank such that the money they deposit is also given out as credit
To them.
to them? The credit that they take,
It's at an interest.
it's at an interest.
And then they share the interest.
The
at
interest
the end
that
of
is
the year.
earned.
They share the
is-
dividends
Exactly.
at the end of the year.
Yes.
That is business for themselves.
That's business for themselves.
And what will be the catch for Ufalme Wetu? What percentage?
This is, as I told you, it's a social impact kind of entrepreneurship. That until you have generated your income, then you can't pay Ufalme Wetu. Until your bank is self-sustaining, that's when now you can be able to
pay
Ufalme Wetu. But for the purposes of creating, the purposes of structures, the purposes of credit, even when they don't have their own money, that's when Ufalme Wetu comes in.
All right.
So, so
quite
now the
interesting.
financial information is very necessary
That's quite
because
interesting.
we don't want people to borrow like they do at what's called at merry-go-rounds to go and buy thermos and seats and cups. We want them to borrow, go and buy a production tool, create an income from that tool,
Yes,
upgrade their livelihoods, come and pay back with interest, borrow more, do something, get better.
And at the end of the year, you are expecting some dividends.
Exactly.
The interest we have accrued from you.
Exactly.
Well, that's amazing. That's an interesting conversation. That's an interesting. Hey, I hope that works. Now,
it works. I think in the next conversation, I think we should go to the field and see people and look at their livelihoods when they started and where they are at now. Practically.
All right.
Yeah.
That's amazing.
Yeah.
Now we have talked about savings, a little bit about investments. What are the robbers? The thieves, the robbers of our way.
Okay, one is ignorance, as we've already said.
But then we have tackled.
Yeah, ignorance, because what you don't know, then you won't act on it. Second thing is the life that we live is filled with so many distractions that we are unable to live that perfect or ideal life.
Yes, sir.
And we talked about them, the black tax, the medical bills, all this, such that even someone who is in a well-paying job, earning 100,000, they cannot be able to save and invest enough to be able to live it off at the end of their working life. Yeah. So lack of information is the greatest one, and then these distractions that happen in life, and then that it's living for let me put it for other people or for the ego. The example you gave about the 85-inch TV. I'm not saying it's bad, but it's better off bought from proceeds of your investment other than what could have been capital for your investment. You see, people, there was a person, I can't remember who, but I heard them talking while passing, and they said something interesting, that most of these people who are employed by these big companies, they will never become millionaires as such, in the sense that they are in a system where they're already trapped. One, they're given a mortgage. Two, they're given a car loan. So this mortgage and this car loan is supposed to be serviced by your salary every month. Such that, yes, you're living in your house, which you'll have to pay for the next 30, 40 years, 20, 30 years. You have a car, which you'll have to change after every 5 years.
And by the time you're changing, you've just finished paying it off.
Exactly.
Then you change it to a better one. They tell you you need to upgrade.
Yes.
Then you take more loan.
And since you're living in a good neighborhood, you have a good car, your kids are going to a nice school, you'll never think about life after this. So since you'll want to maintain that living standard, what do people do? They sell their houses in town, go to shags, rent out the house in town, go find a smaller house. They have to downgrade their living standard because all the income that they got, they never saved, they never invested, so there's no returns for them to survive. And you know, that time when you're retired, it will look long, it will look lonely. And it will look also, how do I put it, embarrassing to be borrowing people for money, or to, imagine you're 60 or 70 years old and you're in a panel being interviewed for a job with Gen Z's. Yeah, so those are things that people don't think about now.
Okay.
And my work is trying to sensitize them, trying to bring this to, you know, because some things you didn't know that you needed to know this. But once you know it and you start acting on it, then you start thinking, okay, what happens when I'm 60?
Okay.
Will I live up to 100, or will I make the statistics that only 4% make it up to past 60?
Yes.
Yeah.
Talk to me about, as we are drawing too close to a conclusion, talk to me about this pandemic that has really, for lack of a better word, enslaved the young people. Get rich schemes.
Oh, yeah.
Maze, we want it like this.
Yeah.
So you hear people are con today, but another company will come tomorrow. Naitawakon.
So basically, when you talked about the Forex exchange, I thought that is what you're talking about. And it's true. Not even young people, most people want that return that is very high, and they want it now. But if you look at it critically, even when you're talking about saving or investing in the stock exchange, basically you're investing in something that is trading. So there's someone who wakes up as the CEO, decides what this company will venture into, and there's a CFO who does the risk analysis, knows this is a good investment, this is not a good investment. There's money that they take from investors, and they actually do the actual work. If it's Safaricom, they actually provide you with service, they provide you with M-Pesa, they provide you with service. If it is this Kakuzi, you see they are growing coffee, they're growing tea, they have a farm. So there is something to back that investment. Yeah. If you say you've invested in Safaricom, meaning you've invested in all that infrastructure. If you've invested in KBL, you see bottles being opened every night. So, you know, that's the investment. But the first thing that people should look at is then what is it that I'm investing? What is backing this investment?
Where am I getting the proceeds in your promise?
Exactly. Because when I told you about the special funds, I told you they invest in commodities like oil, commodities like gold. Yeah. They invest in sovereign bonds by other governments that have high interest rates. They invest in foreign stock exchanges. But here I've come and told you I have this crazy idea that I'm trading in Forex.
You just give me 50,000, I'll be giving you 2,000 a day.
I'll double it in a month. So you mean to tell me, why couldn't you go and talk to Safaricom instead of offering us these services just to make a 20% profit at the end of the year? They give you all their money, you make for them 100%.
Wow. That's
But
good
they're
reasoning.
targeting Hohehahem to give them the little amount, but with the hopes, the greed that they'll get a very big amount in a very short period of time.
It's a mirage.
It's a mirage, but many people are chasing it. And the problem is, with the current situation, people are desperate. People are desperate to make
Very
money.
desperate.
They're desperate so
Get out of the situation.
to get out of the situation. So what did they do? If you come with a project or a story or a get-rich-quick scheme,
I mean,
everyone is in. But that is one thing that, especially the youth or anyone, especially, even when you have money, I don't know whether you've ever realized that when you have money, you have more temptations than when you didn't have.
that is true.
The same case, when you have that money, I don't know where these people come from. So now already in your ears. So get rich quick schemes and also advice from novices. By that I mean, for instance, I can't advise you on how to invest because there is a fund manager who is paid and who does the research and who does work to do that.
There are people who
Yes.
should do that for you.
But you find people go to the kinyozi, as the baba is shaving you, he starts giving you financial advice. Fanya hivi, ukinunua taxi, sijui ukifanya hivi na
Niko na
bodaboda.
besti ninanyoa hapa, anaingishaje mado.
So don't get financial advice. The same way you don't come to me for your medical advice, also don't go to a kinyozi guy or exactly.
That's perfect. I hope that got home clearly. Now, briefly, the elephant in the room,
Yeah.
debts. How do we get out of debts?
Wow. There's
Because you can't do all that when you're sinking in debts. Briefly, how can we get out of debts?
I could ask you the same question, but the same question. How do you get an elephant out of the room?
Maybe you kill it and then you start dividing it into pieces. How else can you do it? Si itakuwa tu.
It's just the same way it entered. You get it out. Yeah, because if it's the room, it didn't just grow in the room or happen magically in the room. It went through a door, got into the room, got a seat, sat down. So the same way, tell it, stand up. Tembe. Fika pale.
Easier said than done.
Easier said than done, but because done is the hard part. So getting out of debt, I won't say it in any particular order, but one thing you have to have that intention, that I need to get out of debt. So second thing, you have to do what we call a debt detox.
What is that?
Getting debt out of your system. There are people...
get detox. Kuna mtu anakopa hata akiwa na pesa.
Exactly. And the people, like banks, they know that is how they make money. So the moment you start operating an account, a few months down the line, they'll send you a message. You
qualify
for this amount.
Yeah.
So debt detox, remove all those apps, remove anything that is associated with debt. Then to have a measurable plan, like whereby you decide, I want to get out of debt after 1 year. Yes. Then we have what you call you consolidation of debts. Like for instance, the circles used to work perfectly where if you have various debts, let's say in this bank, in this microfinance, another person, you consolidate it. Then you go take one big loan from a circle.
They pay all those.
You pay all that.
You are left dealing with the circle.
You're left dealing with the circle. So the prepayments are manageable, the interest is lower.
Okay.
Then
It still happens.
it still happens. You can consolidate your debt. Yeah. Then the other thing is you stop saving.
You stop.
Yeah. Because it doesn't make sense. Look at it this way. We are doing maths here. Where you have a big loan where you're paying 27% and you're saving in an MMF to get 8%.
It's stupid, by the way. It's stupid.
Take that money,
Clear the debt,
clear the debt.
then start saving.
Once you're done, start saving.
For real, because in minus.
Yeah. But people, there is that ego thing, and when it becomes popular, like everyone is saving with MMF, so you have a debt here like Inibado.
And the debt is just accruing interest after interest.
Yes.
Wow.
Then have an accountability partner, especially if it's a family, if you're in a family setup, your spouse. So because this spouse will understand, you have a timeline, so you have dropped your spending, you have cut out all the unnecessary things. Because they also ask people this example. You saving 10,000 shillings every month, and you're getting the 8,000 at the end of the year. But you have a Netflix subscription where you're paying, I think, 1,200 every month. So you end up with an expense of 14,000 to get an income of 10,000. Yeah. So especially when you're in debt, these things are supposed to be done by people who have reached that other level, whereby if I'm saving 100,000 every month, I can afford these things.
So see what you're in debt, but you're gonna go TV,
exactly.
DSTV.
Yeah. So you rat race.
Oh.
Yeah. So have an accountability partner so that when you cut off all these unnecessary expenditures, they understand.
Na haujui uko kwa rat race. Some people ukiona go TV, DSTV, you are just a fat rat, but you're still in the
Netflix, race.
Yeah. You're a fat rat, but you're still in the race.
And I'm the first rat in the race.
Oh, dear Lord Jesus. That's a beautiful conversation we just had. You can tell, content equal, but that's all we had time for. Thank you so much, Joseph. What could be your parting shot to our viewers?
First, this water is very refreshing. I found out I've had 2 or 3 bottles in one sitting. So basically, for people who want to invest, think about it in terms of time. Think about it after you retire. Think about how long will you be able to survive with your current habits of saving and spending. And when you do that math, then you'll be able to make better decisions.
Wow, wonderful. I take you back to where we started. Wealth can be equated with time. The bad news is that time flies, but the good news is that you are the pilot. God bless you, good people. Special thanks to our guest, Joseph Kanani. How do people get your services?
Ufalme Wetu, so we are kwa mtandao zote as Ufalme Wetu. And our office is in Nakuru at Elgon View House opposite Hillcourt Hotel. Opposite Hillcourt Hotel. Yes.
All right. Perfect. God bless you, God's people. Special thanks to the production team and also Jarika Hotel for giving us an ample space where we can be able to do this thing in excellent and in a conducive environment. Until next time, let's keep walking by faith.